All right. Perfect. Perfect. Well, thank you everybody for joining today. I really appreciate y'all time, especially fresh after the new year. I know the last thing on your mind is probably taxes, but tax time is here. So whether you like it or not, it's that time of the year. So I want to really appreciate you all for your time today. And I'm just hoping to essentially give you all some tax updates for individual tax returns. We'll do business owners next week, but this week and today is just strictly just focused on individual tax returns. And then some of the updates for you to apply on the next year's tax return coming up. So, quick little introduction about me because there is at least three faces that I haven't seen before. My name is Darion Wiggs. I'm a licensed certified public accountant, and I'm the founder and CEO of Wiggs CPA Tax and Accounting. Wiggs CPA Tax and Accounting was launched on October 20th, 2022. So we're a relatively new firm, but the beautiful thing about that is I've been able to serve hundreds of people over the last few years. So I'm very grateful to be in this position. And I launched my firm with the intent to just essentially educate those around me and to teach people about taxes, since essentially we don't learn those type of topics in school. So in terms of school, I did graduate from the University of Illinois, Urbana-Champaign, so go Illini. I got my bachelor's degree in accountancy, and I also got my master's degree in accountancy as well, with a concentration in real estate. After graduating, I landed my dream job at the time, started working at Ernst & Young, which is like the third largest accounting firm in the world. And best believe I was the happiest little boy in the world. However, I was very unhappy after working in that environment because I didn't feel like that was the perfect fit for my personality. And during the pandemic, a lot of us were second guessing a lot of things. I just didn't really see myself in that role. So that's when I discovered entrepreneurship, and I discovered that there's other ways to teach outside of the traditional classroom setting. So hence why we're here today. I do webinars frequently, literally just to teach and to educate others about taxes. So that's a little bit about me. I love teaching, new firm, but I'm excited to get into this presentation. So let's get started, everybody. And before I get started, taxes is a boring topic, so I'm gonna try to make this exciting, so bear with me. But I got y'all today. So I'm gonna bring all the energy. So today's agenda. So we're basically going to go over inflation adjustments. I'm going to break that down to you all. We're going to go over tax credits, some tax saving tips, right? I'm not going to just teach you about taxes. I'm going to give you a few tips to help you save taxes in the long run. And then some deadlines and some tips to get you ready for tax season, which is literally right around the corner. And then I'm going to open the floor for questions. So to get started, anytime I do any type of individual tax preparation presentation, I just want to show you all the tax brackets. So right now, for you not used to looking at it, it's a lot of numbers, but basically the point of this is just to put heavy emphasis on the fact that the IRS makes adjustments every single year to the tax brackets to adjust for inflation, right? They understand that the price of housing goes up, the price of food, the price of entertainment. So because of that, your income brackets increase too as well, so that you're not, making more money but then going into these higher tax brackets. So this is just, I always show this to kind of show, if you're single, you just kind of look at where your income is, and then you see your marginal tax rate on the side. So the average American, especially those of us kind of creeping towards that six-figure range or just getting started somewhere between 40 to 95,000, you're typically paying about 22 to 24% in terms of federal taxes. So I always like showing this. This will get adjusted every single year, but I wanted to show you all so you can take a quick look just to kind of see where you fall within that threshold. So that's in terms of the tax brackets, right? So whenever I talk about taxes, especially individual tax returns, I always try to break down the difference between, the standard deduction and itemized deduction. So by law, as a taxpayer, living in this country, somebody who filed taxes, right? You automatically get the standard deduction. Now, the standard deduction is an automatic deduction that every single one of you get each and every year for filing your tax returns. You don't have to do anything at all. You just show up, say, hey, I made 100,000, and you get an automatic deduction. And this is the deduction that everybody gets to essentially account for the cost of living here in the US and also to reduce your tax bill. So if you're single, you made less than, say you made 13,850. That's, well, let me rephrase that. If you're single, you get an automatic tax deduction of 13,850. Married filing separately, 13,850. Head of household, you get a little bit more. And then if you're married filing jointly, you get an automatic deduction of 27,700. So if you made $100,000, you file a head of household, meaning you got a kid and you're a single parent, you get an automatic $20,000 deduction. So you made $100,000, but you get a tax deduction for 20. So you pay taxes on 100K, but when it's time to file your taxes, your taxable income is really the difference. Hence why sometimes people get refunds, because you technically overpay. And the reason for that is because a lot of people kind of overpaid once you take the standard deduction into consideration. Now, the reason why I mention this is because a lot of times, a lot of us get into buying our own primary residence, right? A lot of us will go buy our condos, we'll go buy our own home, right? We start donating to charity. And the common question I always get is, how does this help my tax situation? And the way it works is with the tax code is basically it's either you take the standard deduction, which is an automatic deduction that everybody here get just for showing up, right? Or you get to itemize your deductions. And what that basically means is you get to itemize your deductions if your mortgage interest, your property taxes, your state and local taxes, your medical expenses, and your charitable contributions, if all of these in combination is higher than your standard deduction, then you're able to write off your mortgage interest, your property taxes, your medical expenses, your gifts to charity. So a lot of people think that, yeah, I donated to charity or I got a condo, let me write off this interest. You can, however, because of inflation and because the IRS adjusts the tax brackets and inflation every single year, most Americans end up just taking a standard deduction to help their tax situation. So if this is you, you got a mortgage interest, you pay mortgage throughout the year, you pay property taxes, there are phase outs. Like if you, for instance, if you paid a lot of state and local taxes and property taxes, let's say you pay 18,000, where you only capped at 10,000. That's the only thing that can get applied to itemized deduction. So there are a lot of limitations, which is why the standard deduction in most cases is what you would get. But I just want to educate you all a little bit on the fact that you can write these things off. It always depends on your unique situation. So that's where we're at with inflation adjustments. The pandemic was a few years ago, but it's still relevant to the point where I kind of want to just kind of give y'all some updates. I know it's not too many people in here with a family, right? But I just want to kind of always go into the fact that now that the pandemic tax credits and stuff is kind of behind us, so I want to let y'all know the child tax credit decrease. Like I said, a couple of us don't have kids on here, but for y'all who don't know, the tax credit was like $3,600, and folks were getting like advanced child tax credit payments every single month during the pandemic. So that's no longer the case. They ended that last year. So the child tax credit is only $2,000. The earned income credit, the stimulus check, the unemployment, everything is pretty much changed to how it was pre-pandemic. I'll break these down to you, but I just kind of wanted to show you all a quick list just so you can know that everything is kind of back to normal in a sense for tax deductions when it comes down to credit. So now I want to dive into some credits just to kind of break it down to you all, right? But before I dive into it, this would help me understand tax credits and hopefully help you all too the same. So when it comes down to credits, there's two different types of credits. There's non-refundable credits and there's refundable credits, right? Non-refundable credits mean that it can help reduce your tax liability, but it can't give you a tax refund. And what that basically means is, let's say you owe the IRS $5,000, but you got a $6,000 non-refundable credit. That $6,000 credit would not wipe out your $5,000 tax liability completely, but that excess of $1,000, you don't get a refund. You don't get any money back in your pocket, but you don't owe the IRS money. So a win is a win, you know? However, if you got a refundable tax credit, right? You got one of those credits where if you have a credit that's higher than your tax bill, it's going to essentially put more money back in your pocket and create a refund, right? And just to clear this up, a credit and a tax deduction is two different things. A deduction is like a reduction in your taxable income. So if you made like $100,000 and you got a $2,000 tax credit, I mean a $2,000 deduction, it's just going to reduce your taxable income to 98K. Versus a refundable credit, that's completely different. That's a dollar for dollar reduction in your tax bill. So in the same example, if you owe the IRS $5,000, but you got a $6,000 refundable credit, not only is that credit going to wipe out that $5,000 tax bill, but now you're getting a $1,000 refund. So that's just something to keep in mind that there's two different types of credits. I'm going to go through the most popular credits in a second, but I always want to point that out. So if I say non-refundable, tax bill going down with no refund, but refundable, sounds just the way it is. You get a refund, right? So let's get into some credits, right? The first credit, child tax credit, right? If you ever got a W-2 job and you're in your 20s, and you're wondering why you're not getting a refund for the most part, is because you don't have kids. No, on a serious note, the kids having a child tax credit is one of the easiest ways to get a refund. But the way this credit works is, in a nutshell, is basically you get a $2,000 credit per child that's under the age of 17. Now, during the pandemic, it was $3,600. Now it's back to $2,000. So if you or someone in your family have a child that they take care of and they pay for all of their expenses, more than 50%, and you get a $2,000 tax credit per child. any other person that you taking care of, right? You got your grandparents, you got your relatives, your niece, your nephews, extended family that's living with you rent free, right? You paying for all their expenses. You may not qualify for this $2,000 credit, but now you get a $500 credit per person on your tax return, even if you have a child that's over the age of 17, but you still taking care of them. They're not making enough money to take care of themselves. Well, guess what? You can qualify for up to a $500 credit when you file your tax return. Beautiful thing about this credit is partially refundable. So if you know somebody and they got a $2,000 credit, they can potentially get a refund if they plan this out correctly. And for the business owners in here too as well, these credits can be used too as well to offset your tax liability that comes from your business, but that's another story. So that's the credit there. Second credit always go in after the child tax credit is the child independent care credit. Now, when I hear this credit, I don't know about y'all, I hear child care credit. That's basically a credit for anybody who has children that's under the age of 13. If your parent or you or somebody is taking care of your child, right, outside of the, traditional school, they got a babysitter, they got daycare, they got nursery school, some summer programs, you can get up to $1,000 per child. And if you got more than 2 kids, you can get a $6,000 credit. Now, the reason why I said child independent credit is because a lot of times we just hear child, but it's the child independent, meaning that you also get a tax break if you have somebody within your family that you're taking care of that is incapable, right, physically or mentally incapable of taking care of themselves. They also qualify for this credit too. So just keep that in mind. This isn't just for children under the age of 13, God forbid, but if you got a spouse or, a parent or somebody you're taking care of, you may be eligible to qualify for this credit too. So when you hear it, don't just think it's for children. It's also for those of family members and those people within your circle that you are taking care of too as well. Now, when it's time to file for this credit, you need the provider's name, right? So the daycare name, the person name, if you can, the EIN, the social security number, and then the amount paid to them, and that's how you would get a tax credit. One fun hack and kind of trick I always say, a lot of people kind of shy away from this credit because they're like, I don't want to report my mom's social security number, right? I don't want to show that she has income, right? And the way it works is, as long as that person is making under the standard deduction, under that $13,850, that's going to be tax-free income to them if that's their only source of income. So don't be afraid to put your parents or siblings on here if they're older than the age of 18. They can still qualify to help you get this credit, and it's going to be tax-free income for them. So just make sure you document that and keep that in mind, right? So the next credit is the earned income. This is very popular in certain areas, right? This is a tax credit, pretty much a tax break for low-income workers to help reduce their taxable income and to essentially help create a refund, right? So if you 25 years old and you got no kids, you basically become eligible, right? And this one is based on your income, and it's also based on how many dependents you got, right? So if you're single, no kids, and your income is closer to the 17,000 mark, is a whole bracket. If you're considered low income in this country, you might qualify for this credit, right? It goes all the way up to those who are married and it make up to $63,000 as well. So is the question in chat? Okay, got you. Thank you. So the way it works for this is, right, if you qualify for this credit, you get $600 if you got no kids. You get $3,995 you got one kid, up to $6,604 you got 2 kids. And look at that. If you got more than 3 kids, imagine these folks out here that, got a lot of kids and they aren't making that much money. Look how big this credit can be. So that's definitely something to keep in mind. There are income phase outs to kind of keep in mind and take into consideration. But it's for those of you that's most likely making less than $63,000 or like $17,000 if you're single. So just keep that in mind. But the earned income credit is refundable and an easy way to put more money back in your pocket. So dive in a few more credits before I go into some tips, right? The next set is the education tax credits. And based on the folks in here, this may be very relevant, right? Because as we know, the cost of education in this country is extremely expensive, right? Unfortunately, we can't write off our student loan payments, right? But there are interests, and I'll talk about that in a minute, that we can write off. And then there are these different tax credits, right? The first one is the American Opportunity Credit. That's the tax credit that you get that's up to $2,500 for any time that you go to college, right? These are for the first 4 years. You can get this credit 4 times, right? Basically, if you're paying for tuition out of pocket, you're paying for fees, you got different type of expenses that you have, those books that you're paying for out of pocket, if you report that on your tax return, you could get a credit for up to $2,500, and it is partially refundable, meaning that it can potentially create a refund for you. So that's just something to keep in mind, right? And then there's a lifetime learning credit. Obviously, college in 4 years is sometimes impossible, right? Or you need a fifth year, or you're getting your master's degree, you're going to law school, you're going back to MBA. Now you eligible for a lifetime learning credit. You could take this for a limited years. It's a $2,000 credit. It's non-refundable, but big picture is you're not giving money to Uncle Sam, right? So this one is only for tuition and fees, no books. But the beautiful thing I like about this course is that you don't need to be enrolled in a 4-year institution, right? I can literally be like, hey, I'm gonna go take this course at Prairie State Community College, which is here in Chicago Heights. I can enroll in a course and I can get this credit for it because I'm improving my job skills or I'm basically acquiring new skills. So these are just 2 credits to keep in mind. The ones I just mentioned are the popular ones, but these credits, on top of what I'll discuss in a second, these are some of the popular ones. So any questions on any of that before I hop into a different topic? Feel free, chat, thumbs up. We all good? Do any of these credits vary state to state? Oh, yep. So these are all great questions, Jay. So these are all federal credits. However, different states have different credits. So let's say, for instance, the American Opportunity and the Lifetime Learning Credit, those are federal credits. But here in the state of Illinois, if you're paying for your child to go to like private school, you're paying for your kid to get additional books, etc., you do qualify for state level credit. So there are credits and different incentives at the state level. But today we'll focus mostly on federal credits. But if you got questions about certain states, especially here in the Midwest, I can help you out with those. Yep. Any more questions about those credits? No problem. No problem. All right. Q&A will open up at the end, so don't worry. But any more questions, just let me know, y'all. So the next part is I'm going to quickly go over this, the Inflation Reduction Act, and I'm going to give the highest level overview in the world of this. This was passed last year in 2022, and this was basically the largest commitment by the U.S. government to basically put over $369 billion into the economy to essentially help fight climate change, right? Cool. What does that mean for us? Basically, yes, a lot of these credits were made to help these larger manufacturing companies, right, to create more jobs. But for us, the everyday consumer, the everyday taxpayer, us as individuals, what this credit did was it created a lot of different incentives and tax credits for us to essentially electrify our lifestyles, right? Obviously, us driving around with gas cars, right? Our homes, our day-to-day activities, a lot of times we're doing a huge part in terms of contributing towards the, carbon emissions or however it works into the air, right? So the IRS, and one thing you're going to learn over time, y'all, as we all learn together, is that whenever you hear about a tax deduction or let's say a tax credit, it's basically the IRS and the government giving us incentives to perform a certain activity. So the reason why this Inflation Reduction Act, they want to fight climate change, so like, all right, cool, let's fight climate change. One way we're going to do it, we're going to get Sophia a bunch of new credits so that she can implement it into her lifestyle. Not only are we accomplishing our goal of reducing the carbon emissions, but now she's getting more money in her pocket and essentially reducing her tax bill. So high level picture of how this applies to you all, right? And me, myself, is there's a lot of new energy home upgrades, right? And the first thing you're going to see here is it's operated by the state level for the rebate programs, because there's a lot of different rebates out there for solar panels, electric, wiring, things like that for your home. But there's a lot of different incentive programs at the state level, so look into those. But the ones I'm gonna hit on is the 2 main ones right here, which is the energy efficient home improvement credit. That's pretty much a credit out there that the government has given us to invest in electrifying our home. So this is mostly focused on your primary residence, right? So if you own a condo or a home, you want to get heat pumps, you want to get an electric stove, electric appliances, new windows, or solar panel, electric installation to kind of help keep your energy bill lower. There's credits out there. It used to be a one-time kind of fee, a one-time credit you'll get for $500 for your lifetime. But now you can get up to $1,200 and now $3,200 every single year on your tax returns, a non-refundable credit to reduce your tax bill, as long as you continue to figure out ways to electrify your home. And on the next slide, I'll show you some examples. The next one is the residential clean energy credit. Now, this one is kind of one that's more so for the homeowners out here. But the truth is, these solar panels ain't cheap. I got a client who spent close to north of $60,000, $70,000 for a solar panel. And it was a good investment for his family and for him long term, but it was also a great investment for his tax return. Because with the residential clean energy credit, right, and they keep changing these things, you can get about a 30% tax credit for any major solar energy purchases, such as solar panels or solar water heater systems that you put into your home. So my mom, for instance, just got a solar panel put on her home, right? I'm pretty sure it costed too much money, but now when she filed her tax returns, assuming she paid for some of that out of pocket, she's eligible for this credit. And if she owed money, or if she got a small business and she owes money because of it, this credit comes in handy and it can really help knock down your tax bill. So that's kind of these in a nutshell. If you invested in any of these things over the next year, check to see if you got a rebate or just to do some more research to see how you qualify, right? So you got heat pumps, electric stoves, windows, electric wiring, installation and hair sealing, solar panels, the list goes on and on. So if you like me and you're not really, familiar with these terms, the one thing you can do is you can always set up a home audit, right? And this isn't the IRS agents coming to knock at your door, right? This is a professional within this industry that can come to your home and be like, hey, based on the way your home is set up, George, this is how much you can save on your tax bill. This is how much you can reduce your energy bill by installing some of these things, right? And that's also an eligible expense for you to get this credit too as well. So just keep that in mind. But that's where we're at with those. Reach out to contractors, brainstorm. But I just wanted to kind of point this out that over the next couple of years, you will be eligible for these type of credits for your home. And then my new favorite one is the electric vehicle incentive, right? This was around, but it had phased out because they had like a cap where it's like Tesla and GM and Ford. Once they sold more than 200,000 cars, the IRS was like, nah, you can't get this credit no more for your consumers, which wasn't really fair for, us who just started getting into electric vehicles. But due to the Inflation Reduction Act, they opened up all manufacturing companies to be able to take this credit again. So now, if you are somebody who plan on buying a new EV car or a plug-in hybrid within the next few years, if it's new or if it's within 2 years old, right? Now you are eligible for up to a $7,500 tax bill, right? Tax credit to reduce your tax bill. Sometimes it'll be a rebate to just reduce the purchase price. But if you qualify and you purchase right, now you're able to get this $7,500 tax credit, right? To essentially reduce your tax bill, hopefully reduce the cost of that car. Why? Because the government wants to incentivize us to essentially get into investing in electric vehicles to do our part. So this is this one. The only major changes is one, as you know, in this country, we outsource a lot of our raw materials and minerals and cars from like other countries and places around the world. However, the Biden administration, the presidency, the whole administration, what they want to do is they want to encourage US companies, US consumers to buy products that were assembled here. So the car can be Toyota, it can be made in Japan or somewhere. However, that final assemble of that car must take place here in North America. So Mexico, United States and Canada, it must take place here. And those metals and minerals within that car must be made here in North America. Now, this isn't your job to go figure out, oh, what is the battery in this car made out of? Not at all, right? There's a lot of websites and resources out there where it's like, if you see a car you like, you could just type in, I want the Tesla Model Z or whatever these cars are. It'll tell you if you qualify and what year you will potentially qualify. So this is something to keep in mind. If you're looking to buy a new car, I am in about 5 years, take advantage of this credit. The only thing I want to point out is, because a lot of times you hear credits, and whenever y'all hear credits, y'all, just remember that there's phase outs, right? Not everybody qualifies for this credit. One, if you're making more than $300,000 as a married couple, you don't qualify. If you're single and you're making more than $150,000, you don't qualify for this credit. Because the way they look at it is, if you want to buy a very expensive car and you're making that much money, then you don't need that much help from the government. That's on you. So just keep that in mind that if you're making more than 150, more than 300K, you don't qualify. And there's phase outs for the car. If you're getting a van, it has to be less than 80K. And if you're just getting a regular car, it has to be less than 55K. Now, I say those not for you to remember what I just said in terms of the technical part. I just say that to remind you all that there's phase outs for every single one of the credits I just said, which is why it's important to do your research and look into those things too as well. So before I go to the last part, I do see 2 questions in here. Let me kind of tap on those. So can a lifetime learning credit be used still even if the school year ended in 2022? It can be used. The way it works, Bernard, is that it's a credit in the year that you purchased that, those books or those expenses. So you won't necessarily be able to write that off on your tax return right now, because when we file your tax return in February, it's for all of 2023. However, if you missed out on this credit, and it would potentially help out your tax situation. You can always do an amended return for 2022, and you can add that tax credit there to essentially reduce your tax bill. So just keep that in mind. You should have gotten a 1098-T, which is a tuition statement that you will get every single year from these institutions, and it'll be able to tell you how much you got in aid, how much you spent out of pocket, and then if there's additional expenses, you can write those off too as well. Does that kind of help? You just put thumbs up or let me know. Okay, cool. Bernard, let me know if you need me to clarify on that. And the next one is for someone who purchased a EV car that qualified for an electric credit last year but only got a partial credit, is it possible to take the remaining credit this year? And I guess your question is, you got the car, you got part of the $7,500 credit, but because it's non-refundable, you couldn't get the rest of the credit. Is that what you're referring to? Is it SOAM? We can address that at the end. And George, are you still here? Okay, I'm assuming busy. I'll answer that towards the end. But yeah, some credits are non-refundable and some are refundable. And then the way it works is if sometimes these non-refundable credits, you're not able to take the full credit in the tax year. Some of them do carry on to the next year, but it just kind of varies. So that's one I don't know off the top of my head, but I can do some research for you. And if you want to clarify at the end, I definitely can help you out with that. So the last part on here before we go to some tax tips, and I'm gonna fly through this part, is just some tax adjustments, right? The way it works is you got your standard deduction, you got your itemized deductions, you got your tax credits, and then you got these tax adjustments. They're not much, but if you're an educator, you know somebody who's a teacher or tutorer, and they work within that field, they get $300 if they're single, or $600 per household, assuming both people are like teachers, right? You can get a credit, sorry about that, an adjustment to offset your W-2 wages. Same thing with student loan interest. You can get up to $2,500 in student loan interest to offset your income, basically, right? This isn't your student loan payments, right? And these isn't interest payments that you made a few years ago. It's based on the tax year. And that's one thing I like to point out is you can qualify for $2,500, but if you make more than $90,000 and you're single, you can't get a single penny. You make more than $180,000 and you're married, you don't get to take this deduction at all. So that's just something I want to point out. But if you are a student, if you have started paying student loan interest again, you do qualify for that deduction. And I believe it's a 1098-E that you will get at the end of this month, early February. You can use that on your tax return, right? Next one is a health savings account. Hopefully y'all heard of it. If not, these are one of the best tax deductions, hidden secrets out there, right? What makes a health savings account? Well, first, let me rewind. Outside of education, let me say marriage, buying a home, childcare. I feel like I'm not probably be wrong. Taking care of your healthcare, healthcare expenses in this country is extremely expensive, right? It also is one of the number one causes for bankruptcy in this country. A lot of times we get these fat medical bills and our insurance may not cover it, or we got these gigantic deductibles and we don't have the funds to cover it because we haven't been saving it for the year, right? But a health savings account is unique because it has a triple tax benefit and it helps out with your health savings, right? So the way a health savings account work is if you're single and you have a high deductible plan, meaning your annual deductible, right, is a $1,500, then you can contribute up to $3,850 every single year, well, at least for last year, right? It increases every year, but you can contribute up to $3,850 to a health savings account. Once you do that, you'll get a deduction on your tax return. That $3,800 to get put into a stock market or index fund, or if you self-directed, you can invest it into real estate. That's another conversation. But that money now gets placed in the stock market and it gets to grow. So you're not just getting that little 1.1% that you get in a savings account. You're able to get that 10% that you may get with the S&P 500. But what I'm trying to get at is you get a tax deduction for putting money in. Your money grows tax-free. And as long as you pull this money out for a medical expense, it can be a medical expense in 20 years. As long as you got this account up and you paying for medical expenses with your HSA, you get a tax deduction, it's growing tax-free, and that's tax-free withdrawals for the rest of your life, as long as you're using it for eligible medical expenses. So HSA is something powerful. And what I love about this is you just need to set it up before you file your tax return. But we can elaborate on that later. But health savings account, that's an adjustment. Also, IRA contributions. I don't want to go too much into investing, but you got the Roth IRA, traditional IRA. Just want to let you all know that you can contribute up to $6,500 for your traditional and Roth IRA last year. And then this year, I believe the amount went up to $7,000. But the reason why I mentioned it here is you don't necessarily get a tax deduction for it, But if you are like on the low income side, right, you make less than $73,000 and you're single, you marry, you make less than 116,000. By contributing to a traditional IRA, or in some cases a Roth, you could potentially qualify for a deduction on your tax return. So just keep that in mind, that you may qualify for tax deductions, because a lot of times if you're low income in this country, right, you don't work at a job where they necessarily give you all the benefits that you would working in corporate America, right? So you may be working as a CNA and you may not have a 401k plan, and you also on the low income side, right? So the government understands that. And what they do is they incentivize you to invest in your own IRA account, individual retirement account, and they give you tax credits to kind of help you with it. Because at the end of the day, they're going to have to pay for you to retire anyway, if Social Security still exists. Hence why they give you these different tax credits to kind of incentivize you to act a certain way so they can take less stress off them later down the road. So that's where we at with tax credits. Now I'm gonna go into some tax saving tips, and then we're gonna wrap this up to give you some tips for this tax season, and then I'm gonna open the floor for all questions, right? So my favorite tip, and if you've been to a presentation before, you're gonna hear this every time you hear me talk. In order to win in the game of taxes, you need to be on the winning team. The truth is the tax code was not made for W-2 employees. And the reason why is because you make money, Uncle Sam takes money, and then you get to spend what's left. Now, what's wrong with that equation is that before you even got to spend your money, somebody else took it out of your pocket, right? But you got to realize that the tax code isn't a tax code just teaching you how to pay taxes. It's an incentivized system teaching you how to legally reduce taxes if you play by the game. You got to join the winning team. So the tax code is essentially made for business owners and investors, right? So that's why I want to kind of hit you at having a W-2. I mean, it's consistent income, and I love it. That's the way to go. But this isn't me saying quit your job and invest in real estate or start a business. This is just me reminding you that if you join a winning team or you just continue to educate yourself to learn about different ways so you can invest or invest in real estate, I'll just hop on that next, but figure out different ways so you can invest and join a winning team. That's the best way possible to reduce your tax bill. Because the truth is, y'all, if you got a W-2, don't got kids, and that's your only source of income, it's very hard to reduce your income from a tax purposes, right? It's like you put yourself in a bubble in sense of, yeah, you want to reduce your tax bill, but there's not really that many credits for you, especially if you're in the six-figure range, right? There's not really that many incentives out there for you. However, the two best tips I can give you is number one is invest in real estate. And it's me not saying go buy a 3-flat this year. I'm just me reminding you that there's a reason why the wealthiest individuals all have a real estate profession, all have a real estate portfolio. And the reason why is because not only is real estate helping you build equity, right? It's also giving you the ability to earn cash flow that's tax-free. Because what happens with real estate is, let's say you're making about $10,000 from a rental property for the year, right? Not a lot of money, but it's good money, right? But for tax purposes, once you take into consideration mortgage interest, property taxes, landscaping, repairs, the tenant headaches, and all this other stuff, a lot of times it creates a loss for tax purposes, right? Once you take in consideration all those expenses and depreciation. And for those who don't know, depreciation is like an automatic expense you get that essentially counts for the deterioration of the building. So if you were to buy a $500,000 building, the IRS would give you a deduction every single year of $18,000. And if you're only making $10,000 from that rental property and you got an $18,000 depreciation expense, that's an $8,000 loss. So not only do you make money from this rental property, but if your income is below the certain thresholds, that $8,000 loss can be used to offset from your W-2 wages. And if you pay your cards the right way, now you're potentially getting a refund or you don't have a tax bill at all. So real estate is for powerful, not for, I know it sounds good having rental properties, etc., but just think about the fact that if you get into real estate, you pay your cards right, that is one of the easiest ways if you are solely a W-2 employee to join the winning team and essentially to benefit from the tax deductions. The other one is to create a profitable hobby. This is my favorite one, and next week I'm gonna dive into sole proprietorships, LLCs, deductions, all that. But this is just me reminding you all that a lot of times, a lot of us have hobbies and things that we do, and we don't realize that that can be a business, right? And I got some IRS agents on here, so former IRS agents. So let me know if I'm going swinging left or right. But the way I understand it is that if you have a hobby and you have the intent to make it profitable, you technically got a business. And if you got a business and you're doing this the right way, right? You're documenting all your expenses, you get an entity set up if you need one. Now you're a business owner in the eyes of the IRS. Now a lot of your everyday expenses now become deductible. I got a lot of people who write music, they do graphic design for fun, They do cooking classes for fun. I got photographers. People do arts and crafts, dog sitting, babysitting. They do it. They make some money, but they don't report that income. They're like, oh, that's chump change. That's small. However, if you just take some time to come up with a business plan and think about how you can make this profitable, it's not me saying quit your job or you need to make 100,000 from it. But if you structure your hobby in a way that you can consider it a side business and follow the rules, now a lot of your personal expenses now become deductible. Your phone bill, your internet, your mileage, your meals, the travel, like all these expenses become deductible. And if you play it the right way and you obey within the hobby loss rules, which you got 3 years to do so, now you're able to use those losses from that business to offset your W-2 wages, just like you would with that rental property, and legally reduce your tax bill. And if you play your cards right, you're getting a fat refund. So that's just why I want to point out, if this is you got a hobby or something like that, next week would be perfect for you. But like I said, W-2, you kind of in a bubble, but real estate, always investing in yourself and then figuring out a way that you can incorporate your hobby. Those are some of the best ways to essentially reduce your tax bill. So I'm open the floor for Q&A in a second, but I just want to give you all some quick tax season prep tips. All right, y'all, tax season around the corner. The Super Bowl is too. So what that means is you're going to see TurboTax commercials every day you look up, everywhere you walk in Sam's Club, Liberty Tax, H&R Block, you name it. So give you some tips real quick. Tip number one is to just gather all your financial documents. This isn't going to change, people. You can get your W-2s together, your 1099s. So the law is basically that all employers, anybody you work for, has to send out W-2s and 1099s by January 31st. So that means starting in about 2 or 3 weeks, first few weeks of February, you'll have all the documents that you legally should have from these places. If not, they're going to get penalized, and we can cross that boat when we get there. The first thing is gather all your documents, right? Your financial documents. You got a business. Start gathering those expenses. Don't wait until me to tell you in February. Start today. The second one is pull together your family's personal information. If you got the same tax preparer from year to year, we should have it already. But if you had a new kid or in addition to your family, or you got a new tax preparer this year, just get all your family information consolidated together just to make your life a little bit easier, right? The third one is pull your IRS transcripts. This isn't a requirement for everybody. But we all know that one person who ain't filed taxes since 2014 or ain't filed taxes since 2019 or 2020. And the reality with that is you can still file, but you lose your documents over time, right? You move, something happened, the flood happened, the pandemic happened. And a lot of time people don't know, one, what they received that year, and then what, documents they should have had. So I always recommend, if you don't know what you actually received, pull your IRS transcript. And for those who don't know, IRS transcript is just a document showing all of the income that you receive for the year. Hence, I said that these documents, your W-2s, 1099s, they get sent to the IRS first. And then we get a copy, which means that the IRS has a running record. So if you, your family, or you don't know what you received or you need that information, definitely pull your IRS transcript. That's the best way so you can see what income you got. Find a qualified tax professional. Always recommend that. And I'm going to keep it a buck honest with you all. If you just have a W-2 and you didn't make that much money, you can file for free. You can use TurboTax. You go to a family friend. That's perfectly fine. But the moment you got stocks, the moment you just sold a home and it's a taxable event, the moment you got a side business, the moment you got a business, the moment your situation becomes more complex or you're eligible for a lot of these credits I just said, that's when it's time to go to somebody who understands it. Because when you use TurboTax and these other softwares, if you check the wrong box in the beginning, you ain't getting that credit. It's not Turbo's tax job to make sure you're getting that electric car vehicle. If you accidentally check no, or you put, oh, my kid was 13 or 14, you're above the age for the care dependent question, they're not going to bring it up no more. So just make sure that you have a qualified tax professional and then file ASAP to avoid deadlines. The deadline, I believe, is April 15th. So you have a couple months, but I always recommend filing. And then lastly, be patient with the IRS. The systems are a bit outdated and they're still catching up from the pandemic. So just give them some time. So last thing, W-2s, 1099s, those should be sent to every single one of y'all by the end of this month, meaning you'll have it within the first 2 weeks of February. The tax deadline for personal tax returns is April 15th. And then if you can't file by that day, you do get an extension, which gives you until October 15th. But the truth is your tax bill is still due on April 15th. So just keep that in mind. Even if you file for an extension, you still want to get your returns filed by the 15th. And that's pretty much it, y'all. I will open up the Q&A in a second, but I really appreciate all y'all time and you paying attention to your questions. I'm looking forward to answering questions, but definitely stay connected. Website, wigscpa.com. That's my email, my phone number. I'll send you all my information afterwards. And I also try to post 2 to 3 videos a week on Instagram. just to kind of educate my friends and my community. And then if you're interested in next week's webinar, I'll see you the information, but definitely sign up for that. And then I didn't mention it, but Wiggs CPA Tax and Accounting. So we do prep taxes during tax season. We mostly focus on business owners. So you somebody who have a business or you have a hobby on something on the side, we can help you. And we do have limited stock spots for individual tax returns. So we can help you. But our main focus is working with service-based professionals earning six figures who need help with bookkeeping, payroll, tax planning, tax prep. We do it all for you. But we would love to assist you all any way possible. So thank you all for your time. Let's get to some questions, and anything I don't know, I'll definitely point you all in the right direction. So thank you. Let's see. I'll share my screen. Yep, and if you got questions too, you can literally just oh, did I just cancel the Zoom call? Oh, sorry. If you got questions, you can literally just come off mute and I can do my best to answer them. And I see it's a couple in the chat, so I'll save those. You on mute if you're talking, Linda.